சார் சார் வணக்கம். உள்ளத்தார் பொய்யாதொழுகின் உலகத்தார் உள்ளத்தில் எல்லாம் உளன் என்றார் வள்ளுவர். ஒருவன் தன் உள்ளமறிய பொய் இல்லாமல் நடப்பானால் அத்தகையவன் உலகத்தாரின் உள்ளங்களில் எல்லாம் இருப்பான் என்ற வள்ளுவ பெருந்தகையின் வாய்மொழியோடு இன்றைய நிகழ்ச்சிக்கு செல்வோம். On behalf of Coimbatore branch of the Institute of Chartered Accountants of India, a very good evening to all my professional colleagues. I take immense pleasure in welcoming you all for the third webinar. There are various guidance and changes by IT department to trust activities trust activities issued by the IT department. Today's title, Taxation of Trust and Recent Issues with respect to the financial year 2020. Dr. CAE Phalguna, past SIRC chairman from Tirupati, is a good speaker and practical experience to handle the trust activities. I take delighted in extending my welcome to Speaker CAE Phalguna sir. We welcome you, Phalguna sir, and also welcome our Secretary N.B. Palanisamy and our immediate past chairman of our branch, Sri Balasubramaniam. Welcome you, sir. The today's session about the trustee is very useful to all the members of our fraternity. And I especially thank to our branch staff and admin of today's session, Mr. Mahil Vannan. I thank you, sir. And I forwarded to our past chairman, Mr. Balasubramaniam, to introduce our speaker, Dr. E. Phalguna. Thank you, sir. Thank you very much.
Respected Chairman, CAI Sanmugam, and Secretary N.B. Palanisamy, Speaker of the Day, Dr. C.A. Phalguna, and dear members, good evening to one and all present here. At the outset, I would like to thank the Chairman for giving this opportunity to be the part of this event. Learning is never-ending process. Lockdown is not for learning and sharing of knowledge and information. Chairman not only choose the right topic at right time, he also chosen the best speaker in India to address the today's topic. Many members already raised the queries and questions about the renewal of registration of trust and the rules and forms. I hope that all the members to hear this seminar will benefit out of this session, and this is the right time to address the registration of charitable trust and the recent issues in the charitable trust. It is great pleasure to introduce the expert, great leader, and a humble person. Dr. C.A. Phalguna is a fellow member of ICAI, practicing as Chartered Accountant at Tirupati since 1979, as managing partner of E. Phalguna and Co. He is married to Srimati Vijayalakshmi, who is also doctorate in home science and worked as principal of TD College. They are blessed with 2 children, son and daughter. Both of them are qualified CA, practicing with father, and daughter-in-law is also practicing in this work. Phalguna graduated MA, MCom, MBA, BL, DISA, PhD. He is a member of Institute of Common Secretaries. He got recently qualified in the Independent Director of Eligibility Test. He was a member of Regional Directors Advisory Committee. He was appointed as a member of Board of Trustees of SV University and also SP Meghalaya University for the period 2012 and 14. He presented more than 360 technical papers in the various CP seminars across the southern. On GST, he has delivered more than 50 lectures across South India. He got his doctorate in accounting and auditing standards for non-profit organization from Sri Venkateswara University, Tirupati. He is serving the society as trustee and executive member of several charitable institutions at Tirupati. He has been appointed as Finance Committee member for the year 2020 and 22 of IIT Allahabad. He was elected to the Southern India Regional Council of ICAI in December 2019, 12 and 13 elections. He was the chairman of SIRC of ICAI for the year 2016-17. With these few words, I request the speaker of the day, Dr. C. A. Kumar sir, to address the members in virtual seminar. Thank you. Thank you for the opportunity.
Thank you, Balasubramaniam, for introducing me in a nice way. Now, Chairman, if you permit, we can start the session. Or,
Okay, sir. Okay.
So, good evening to all the viewers, the Chairman Shanmugam, Secretary of Coimbatore Branch Palniswamy, and the immediate past Chairman Balasubramaniam. Actually, last year for Balasubramaniam installation function, I was invited 2019 February for Balasubramaniam as Chairman for his installation function. Your branch has invited me a number of times. I have come to your branch. I am thankful to the branch managing committee for once again arranging this webinar. Now, as this because of COVID, we are all meeting only through virtual meeting through camera rather than physical meeting. But we are missing in the past 3 months without a physical meeting. I myself feel a little bit different way. So anyhow, we are going to deal for 2 hours nearly the public trust, mostly religious and charitable trust. So with these trusts, how the taxation is there and what are all the changes that have taken place recently. So the area of professional work in this respect definitely is a very, very interesting one in the sense, unless you are updated not yearly, at least once in 3 months, both with the case law and the amendments that are brought in by the government, unless one is updated, it is very difficult to continue this professional or say render good professional advice. So now the topic heading I have given public trust registration and taxation and the recent issues. So maybe 4 or 5 years, 2015 onwards, now how many changes have come, both by decisions wise and by the sections that are amended, the rules that are changed, the format that is changed. All this we are going to discuss, as Chairman has touched and Balasubramaniam also has touched. This 2020 budget is going to bring in a radical change. So that 2020 budget radical change also. So this 2020 budget is going to bring in another new dimension, this is Finance Act. That is nothing but everyone has to, once in 5 years ago, they were already having a registration under section 12A or 1023C. Again, they have to seek a fresh registration beginning from this year. Without this COVID pandemic, it would have been from June 1st itself started. Because of this COVID pandemic, the date is postponed to October 1st, 2020 as of this day. On March 31st, by an ordinance, number of changes have been brought in the Income Tax Act. So among those changes, this renewal of the existing registrations has been postponed to October. So what is the renewal process? What are all the difficulties you are going to face and how to deal with it at the end? There's almost at the end of my session in these 2 hours, I'm going to deal with it. But primarily, as the members expect, what are the difficulties in filling up ITR 7? So after you filing the ITR 7, not less than 25% of the cases, some notice or the other, we are going to make 143 1-year adjustment. Something we are going to, your accumulation notice we could not find, so we are going to add, though you claimed in the return, we are going to add. You have not filed the audit report, you have not linked it. So like that, some information is missing, thereby some tax liability is going to arise. So that's how the minimum 25% of the cases people receive the notices. To avoid such notices, to avoid such difficulties, what sort of precautions one has to take while dealing with these public trust registration and taxation with these retent issues. So I will be deliberating. This is the agenda at the time of formation, at the time of registration with the income tax department, at the time of computing the income every year, what precautions one has to take. So, and then after computing, while uploading, while filling up ITR 7, what sort of common mistakes are taking place and how to avoid them. And then even if you receive some notices, how to respond and then try to minimize the tax liability and really make them enjoy the statute given exemption, how to cooperate. This is how the agenda for today, including these amendments. Actually, in this 2020 itself, around 6 notifications have, CBTD circulars have come. So they are giving some facility to the assessees to redress the difficulties what they have faced. So what those CBTD circulars in this 2020 also has come, 19 they have come, 18 they have come, and what are the latest circulars and how to use maximum their benefit. So this is how we have to see. Next, please. Admin, please change the slide. So when you talk about this public trust, when you talk of this public trust, so the 2 routes are there, as we know. Actually, the taxation of the charitable trust is 2 different ways in the sense, either you can enjoy section 10 exemption, or you can go for section 11 exemption. To get the section 11 exemption, you have to register the trust. Say, though we use the word trust, the Income Tax Act also has used the words in these 11, 12, 13, either a trust or institution. These 2 words are only used. So trust includes society. Please understand, trust includes society. In the Trust Act is different, Societies Act is different. But the Income Tax Act has not used separate words. Even a Section 8 company, earlier Companies Act, Section 25 company, now the present 2013 Companies Act refers to Section 8 company. So the trust word includes all these charitable institutions. Admin, actually, you are in the slide, another slide, I think. Go to immediately, next slide, please. First slide. You are going forward. Go to number 2, slide number 2. You are having slides number 2. Number 1, the title, number 2, slide number 2. Okay. Okay, slide number, no, you go to the previous one. You go to the previous one, 12A registration. Okay, so now the charitable institution, as a professional, we should know that there are different ways of forming a trust, either as a society or under the Trust Act. For example, a wealthy man, after his life, he wants to dedicate by creating a trust. Through his will also, his property after his death can come to a trust, whereby the trust will get its birth only on the death of the author of the trust, that is through will. So, or as a living person, I want to see that I will promote a trust. So now itself, I will transfer my personal property to a newly constituted trust, either money or the property. So in that way also a trust can come into existence. But the present Income Tax Act says every trust, even initially if it receives the immovable property, cash or through bank, whatever is there, the trust without 12A registration, which entitles it for Section 11 exemption, the moment it receives, though as a corpus fund, the land given, the land value without 12A registration under 56(2)(10) is taxable in the hands of the trust. So the other source income 56(2)(10), which is from 1819, which has replaced the 56(2)(7). So the 56(2)(10), the other source section, now earlier for individual HAF, now for any entity, whether it is AOP or BOI or a trust, a public charitable trust or a limited company. So for everyone, once it receives some property, that the specified properties, the land, either the building or say the money, shares, all these things definitely are becoming other source income without Section 12A registration or 1020C registration. So one has to be very, very careful at the time of formation itself, because unless you apply for registration initially and you get that 12A registration, at the time of application itself, normally the commissioner will say, the exemptions commissioners, CIT exemptions will say, you start your activity, let me believe that you are doing genuine activity, then I will give 12A. Because the present Act 12A section says, after we applying, 6 months time is there, either to reject or to grant. So they want us to prove that the society has or the trust has commenced its activity. So the amendment this year 2020 is for such a difficulty, to remove such difficulty, they are giving a provisional registration. They have proposed in this year budget a provisional registration. So provisional registration is valid for 3 years, and then so immediately after the trust registering, obtain a PAN number and then apply through Form 10A. Now the 10A earlier was before February 2018, it was a manual filing. Now it is online filing. So online filing means either through digital signature or through EVC, you have to file, verify, and then this application they will consider. So for the existing trust or new trust, existing trust without 12A, they have to apply now, or new trust formed recently, they too have to apply before receiving the money or before receiving any property, they have to register with the Commissioner of Income Tax. So this registration process, how it is going to change, or new registration process or a renewal for the existing. Already we are having 1023C registration. So it is known as approval. 1023C registration is otherwise called as approval, whereas 12A registration is called as registration. So whether the 1023C approval or 12A registration, though they are having for the past 10 years, 5 years or more, or since time immemorial, but they do have to afresh this year after October 1st, must once again apply for renewal. Now the renewal for 5 years they are going to give, and before the expiry of the last 6 months in these 5 years, once again renewal has to be obtained. Whereas this fresh registration, 3 years only is a temporary registration is given. So before expiry of the last 6 months or within 6 months from the commencement, for example, a fresh society or a trust applied for 12AA, they will give provisional registration for 3 years, but within 6 months itself, the activity has commenced. That means the educational activity or a religious activity within 1 year, say, they have commenced. So after commencement, within 6 months, permanent registration once again you should apply. So right from the first day, they will give for maximum 5 years the permanent registration. Once in 5 years, again you have to renew. So this is the registration process. Now in the registration process, what sort of mistakes as professional somebody has done? So the 10A form expects you to attach existing trusts last 3 years audited financial statements. So at the time of registration, for example, there is a big temple in Coimbatore. That temple, because it is managed by Tamil Nadu State Hindu Religious Charitable Endowments Act. Under that act, it is managed because State Government Endowments Act is covered. Officers think that its income is exempt. It is not so. Under the Income Tax Act, where it is a central government promoted society, trust, company, corporation, they have to register if at all they are doing a public, religious or charitable activity. For example, central government promoted universities, central universities. As we know, state universities are their centers. Now in the past 1 year, several central universities are facing the trouble of income tax because those central universities are not registered under the Income Tax Act. In their gross receipts, government grants are less than 50%. So from 16-17 assessment year, every university, whether it is having substantially financed by government, state government or central government or not, it has to file the return of income. So several universities are not filing the returns of income. Central universities having more than 50% the fees collected from the students, self-financing courses. So without 12A, their surplus income is taxable. So the government left and right has issued the notices to all those universities. Now they are trying to apply. What precaution we have to take while applying? Though you are existing for several years, last 3 years accounts first you get audited. Don't file the return of income. The Income Tax Act is not expecting you to file the return of income. It is asking you to submit the last 3 years audited accounts. So the last 3 years audited accounts along with Form 10A, let us submit. Why? The Section 12A, subsection 2 was amended, adding 3 provisos. In those 3 provisos, the sum and substance is, once you get a registration now, and in the earlier years, if you are complying all the provisions of the Income Tax Act, as if you had the registration earlier, then for earlier years, the assessing officer is precluded from issuing any notice reopening of income escape, section 147, 148 notice, nothing can be given. Similarly, for existing pending assessments also, if once a registration is given, this section 11 exemption, if you get it for a registration, for earlier year also this section 11 exemption has to be applied. So if the application is rejected, no, the normal taxation provisions will apply. So this is the sum and substance of that 2014, the present BJP government, when it has assumed the power, it has amended with effect from October 1st, because it knows that several charitable institutions, religious institutions were not having the registration. So instead of retrospective registration, earlier some 20 years back, it was there, the power of the commissioner. Now that retrospective registration giving power commissioners are not having. So to enable these institutions, these provisos are added. So even now, and as I have just 10 minutes back told you that from 18-19 assessment year, without registration, though 100% the donations you received, the income you received, the trust is spending for public charitable purpose. When it comes to computation of other source income, only receipts are taxable as income. Your application is not going to be considered, not the net income. Why? Because the definition of income, 224, voluntary contributions is equal to income. Any amount applied is not there unless the donor makes it a condition that if you are not applying, please return to me. That generally will not be there. Then if it is not a conditional donation, then gross donations are taxable income without registration. So while applying, you file the return. The moment you file the return, the local income tax officer exemption will try to assess and levy the tax. So the section 11, 12, 13 is a code by itself. In the Income Tax Act, as we know, normal 5 heads are there. For charitable institutions, for public religious institutions who got section 12A registration, normal 5 heads computation will not apply. You should not, by mistake, apply the computation. So, though in the ITR 7, such heads are there: house property income, business or professional income, other source income. Those heads are there in the ITR 7. The ITR 7 is to be filed by not only the public, charitable or religious institutions who have got 12A registration or 1023 registration. Many others are also there. What are the many others? Maybe 1024, a trade union, its house property income is exempt. It has to compute and claim, and the other income is taxable. So only house property and other source income is exempt, other heads income is taxable. So the computation of income, normal 5 heads computation of income is not applicable for 1020C approved institutions or section 12AA registered institutions who are enjoying section 10 and 11 exemption. They need not compute their income. There is a different way that computation we are going to see. So the registration process, one has to apply, and the registration during the previous year, even at the last day if you apply, and within 6 months, though in the assessment year you are going to get the registration, the exemption is available right from the first day of the previous year, though you have applied in the last day. So one has to seriously look into the registration aspect if at all they are not having the registration. Now, who has to get the registration? All public institutions, all non-profit institutions need not. For example, a residents welfare association, in an apartment building, big building, 40 residents are there, 100 residents are there. They form an association as per the RERA Act. The builder himself will form an association and hand over the common properties, that is cellar, parking area, rooftop open area, all these things the builder has to hand over, that lighting, that meter, physical handover, all these things. So then the association, because of principle of mutuality, several associations, several institutions, for example, a consumers cooperative society. A consumers cooperative society works on the principle of mutuality. A social club so works on the principle of mutuality. So long as the institutions are working on the principle of mutuality, that is, members only are contributing the income and members only are enjoying the income, then they need not take, they should not file the return of income, they need not take any registration will not be given, they should not apply. So the institution to which we are applying, we should know. Then only, for example, many people apply even for a public provident fund, recognized provident fund. In a limited company, 1,000 employees are there. The employer statutorily constitutes a provident fund, gratuity fund, superannuation. These are governed by the income tax rules. They should be registered with the Commissioner of Income Tax, regular Commissioner of Income Tax, not the Commissioner of Income Tax exemptions. So if you go through the income tax rules, only the format in which we have to apply, how to draft the deed of this provident fund trust, gratuity trust, superannuation trust. So they enjoy the exemption under section 1025. There is no necessity of going to a chart. It's not a charitable activity. It's not a public activity because persons of beneficiary who are going to get the benefit are identified. When the persons are identified persons, no necessity of no question of treating it as a public charitable. So the exemptions available under section 10, the For principle of mutuality, there is no section in the Income Tax Act. Only by virtue of the legal jurisprudence, because of the decisions of the courts, right from high courts to Supreme Court, number of times they are not having any taxable income under the Income Tax Act. They need not file the return of income. So like that, the section under which the institution is working, one should be thorough. For example, 1046. Any state government or central government jointly or individually promoted body, not necessarily society. For example, urban development authorities. Nowadays, Mahanagar Palika, Bangalore Mahanagar Palika, or some other urban development authority throughout the country. So there is an Urban Development Act, and under that act, the authorities, that authority is also taxable if at all it is having income. But for such institutions, 1046 gives a separate exemption. So 1046 also can be applied, and if 1046 approval is obtained, it can instead of 1023C, because 1046 is conditional a little bit. 1023C is for general exemption, 1046 for heads of income exemption. So the institution to which provisions are applicable, and whether we have to apply under section 10 or under section 12AA, we have to see. Actually, the 12AA is replaced by this Finance Act with the 12AB. As I said, the 12AB is operational from October 1st, 2020. So, for example, trade associations. Trade associations means cloth merchants, Coimbatore Cloth Merchants Association, Coimbatore Spinning Mills Association, or some electrical motors producers association, distributors. They are all known as trade associations. For trade associations, separate provisions are there under the Income Tax Act. So, as I have given you 44A and section 2813 and 1023A. So, these provisions, how they are applicable, to which extent the income is exempt, whether they are going to use the principle of mutuality. The trade association only for members means go to the principle of mutuality. Not only for members, for others also there, then these provisions, how they are applicable. Like this, one has to go through all the provisions and then give the advice. So, how the Income Tax Act given an exemption can be maximum applied. Next, please. So, the difference between section 10 exemption and section 11 exemption. Admin, please change. Okay. So the section 10 exemption versus section 11 exemption, which of these things one has to choose? As I told you that the 2020 amendment also is giving a choice to the existing public trust or religious trust. What it is saying, though you were earlier having 1023C and section 12A registration, here afterwards, no, only one you have to choose. In addition to these two, now they have added in this year budget 1046. So though you are a government promoted, 100% government owned the Urban Development Authority, you have to choose. You want 12A registration, that is a 12AB now, 12A is replaced. Or that is a section 11 exemption you want, section 1023 exemption you want, or 1046. One of these things you should choose. And after choosing this, after 3-4 years, you want again come back to what you have lost, or you want another section exemption. Then you apply for the first registration. Once, say you are having 1046 exemption, then you want to switch over from 1046 to section 11 exemption by having the registration 12A. Then you should apply for 12A registration. Then if you once get the new registration, 1046 is automatically ceasing to be the effect. So like this, they propose, because earlier big education institutions like engineering colleges, medical colleges, they used to have both 1023C 6A and because of more than 1 crore gross receipts and section 12A registration, both they were having. Either of these things alternatively every year they were choosing. So not necessary, because only in the auditing you will be finding. And section 10 exemption, you want audit report 10BB you have to file. Section 11 exemption you want, audit report 10B, we have to file online. So the difference is there, people used to file 2 audit reports, either of these things, partly here, partly there, all that now has been put a full stop with this year budget amendment. So either 12A registration, which is replaced by 12AB, or section 1023C, or if it is a government promoted institution, 1046, either of these things only one has to choose. So now the section 10 difference between the 1023C and 11 is, in the case of section 1023C, once you get an approval, it's approved charitable institution, at the time of assessment mainly, the assessing officer cannot deny the exemption for small violation without the prior permission of the Commissioner of Income Tax Exemptions who has given the exemption. Whereas in the case of a fully registered institution, if in the scrutiny assessment some small violations are there, section 13 is enunciating so many conditions. If some of the conditions, if an institution is violating, it is not satisfied, which the auditor could not point out in his audit report, in the scrutiny assessment, the assessing officer has pointed out. In such cases, the assessing officer can deny the exemption while completing the assessment by himself. So if it is a 12A registration, the assessing officer can deny the exemption and then complete the assessment, whereas if it is a 1023 approved institution, he must first write to the Commissioner of Income Tax Exemption for denying that exemption. That is the main difference. The other differences are sorted out now. The other differences, section 11(1)(d), corpus fund donation. If a 12A registration institution is there, for applying 85% of its income, corpus fund donations, that means the donors who specify that my money shall not be used unconditionally, my money shall be form part of the corpus fund. Maybe you keep the money as FD and use the interest, or maybe you construct the building, use the building for public charitable, like that. If a donor specifies a condition, it becomes a corpus fund donation. So then such corpus fund is out of the total scope of the income, which 85% you have to reckon. So that is available in section 11. Now such thing also has brought within section 10, all these 20, 30 years, it's not there, it's now brought at par. So the section 10 exemption is advantageous for those institutions which are purely education institutions, purely medical institutions, except educational activity, no other activity they do, then you go for 1023C. If you are having less than 1 crore gross receipts, that's normally I quote, every street corner you will find a school, government recognized school, elementary schools, normally LKG, UKG to class 1 to 5. So these schools, normally their gross receipts will not exceed 1 crore, then better, even without any income tax registration, that a 1023 small 380 they can enjoy. So then you opt for section 10. You need not go for a 12A registration and claim section 11 exemption, because section 10 exemption is liberal for much small institutions. They need not comply several, that 85% application, all such things they need not comply. So even the audit report 10B is not applicable for such institutions, so small institutions where they have less than 1 crore gross receipts. But normal audit report is necessary. So under the Societies Act or under the Trust Act, when the management is dealing with the public money, they have to get the accounts audited. That audit report you have to file. And in filling up the ITR also, are you audited? Yes. Under which act you are audited? Please specifically say under Societies Act, Trust Act I have audited, not under Income Tax Act. So the filling up also is necessary. Then only that less than 1 crore institutions can enjoy the exemption. If you say no audit, then they will not give the income exemption. So like that, the section 10 exemption and section 11 exemption are two different routes. Earlier, both the routes are something one was taking, but now only one route one has to choose. So that with careful, say for example, a university is there, let it be a central university or a state university. If it is having a proposal to enter into agreement with a foreign university, then as a joint venture, both of them want to start a research project, then out of the research project, if they derive any patent rights or copyrights and they want to exploit to the society by selling those rights and then derive some more income, then in addition to education, they are doing something more, a little bit commercial activity also. The knowledge which they got, for example, most of the IITs, they develop so many mechanicals or software, new tools, new techniques, new research findings. Those research findings are useful for the society. So then they cannot give freely. So they sell it to so many manufacturers. So they derive sale of copyrights, all this. So then it is a commercial income. Actually, in such case, the object is to propagate benefits to the society, not with a profit motive. Then you register under 12A rather than purely under 10, because it should be solely existing for education. Then you go for 10(12)(c). If it is not purely for education, it is having some allied activity also, which is also charitable activity, better you go for 12A. This is how one has to choose whether section 10 or 12A, because now the renewal time has come and one has to choose. We are not past what has happened is not going to be same. Now one should be very careful. So the unregistered AOPs, for example, out of charity, a COVID relief fund, you want to collect some money and then send to government. Once you collect, at the time of collecting itself, some 20 people, 30 people gave you 20 lakhs and you gave it to the collector. But in your name, if you collect, though you keep a name, so-and-so colony residents contribution, you once receive, it becomes a taxable income because it is unregistered AOP. So one should be very careful in dealing with the money, though it is for a public charitable cause or a public religious cause. So that's all. Next, please. So we are going to see next slide, admin. So the incomes we have to, after you getting the registration, normally annual accounts we have to file. Now, what is the nature of the income one has to examine? What is the nature of income? Either broadly it can be a religious institution income or a charitable institution income. What is religious and charitable? In another 2-3 slides we are going to see what is religious income. Sometimes it may appear religious income, it may not be a religious. Sometimes it is a charitable income, it may not be charitable, it may be religious. So how to examine that? Because the exemption is a conditional exemption for the purpose for which you have applied. Before 2018, the form 10A, simply if you write charitable purpose, it's all right. But now the form 10A, is it a charitable purpose? Which is charitable purpose? The definition 215 says relief to poor, medical relief. You must tick. Is it relief to poor? Is it medical relief? Is it education? Is it advancement of another object of public utility? The last clause, advancement of another public utility, is most dangerous. The most assessing officers are using it more critically, in the sense the amendment has come through the 2008 Finance Act, applicable from 2009-10 assessment year. I am going to show you in the slides itself. This clause has been applied to the CA Institute, ICAI Institute. So ICAI Institute, which was enjoying section 1023C 4, 1023C 4, public charitable purpose institution. After the amendment, they said your income and expenditure account, audited income and expenditure account, you being the auditors, is showing surplus year after year, and the surplus is also out of the students' fees, coaching classes fees, and the expenditure you have incurred. When compared, the income and expenditure is giving some surplus. So yours is not a public charitable institution. You are falling in advancement of another object of public utility. And once you are falling in advancement of another utility, if the gross receipts of this nature advancement and availability exceed 20% of the nature of commercial nature, trade, business or commerce nature. That means for a profit motive, you are collecting the fees, cess or by any other name for the services you rendered or for the goods you have sold, some money you are receiving. Then your object is advancement and availability, and in addition to normal donations or in addition to normal say bank FD interest or investments income, you are collecting some money. That collection is in the nature of trade commerce, and then such receipts are exceeding out of the total receipts more than 20%, then you are no longer a charitable purpose. The definition of charitable purpose is amended in such a way with these provisos that once the officer applies, I give you a live case I got from a case from Kerala. A church has in its audited accounts the church hundi collections, church donations received from known people are much less, and in its income side, rents from shops let out. Church has constructed all around it. That means church is a very big compound. Maybe in all the 3 sides or 4 sides of the roads, it has constructed the shops and let out. That income is 60%, 70%. So then the assessing officer said, you are no longer a religious institution. You are only helping the shops to do their business. So any service in the nature of trade, commerce or business you are fitting into, you are helping only the commercial activity. Your income shows that. Thereby, you are not a religious institution. You are not a charitable institution as per the definition of 215. Then please on the surplus income, please pay the tax. That's what the officer proposed. So he actually is completed the assessment also on that line. But we have argued that don't see the income and expenditure account, just like CA Institute, where the Delhi High Court said, don't look into the income side alone. What is the primary object, dominant object? The theory of a dominant object and the ancillary object has to be applied. Thereby, expenditure side, it is doing religious activity. All expenditure is only for the religion. To meet that expenditure, when there is no income, what it has to do? It must raise its income by some other means. So the vacant sites, it has let out, or say constructed the shops and let out. Thereby, it is not a commercial activity. Main objective you have to see. The main object is only to serve the religion. Maybe an education institution is having an auditorium. Its auditorium, if it let out, that's out. Then education institution may have more than 20% letting out of auditorium. So 365 days the auditorium cannot be used by the education institution. It's a cricket ground, let us say. It's lets out to students or say some other schools for playing. It collects some nominal amount. So thereby it's not good. The main activity, if it is not falling in education, relief to poor, medical relief, and coming in advancement of another objectivity, then alone this 20% has to be applied. So which are all the normal things that fall, that will not fall in education, medical relief, relief to poor, and fall in this is, for example, cricket associations, music associations, dance associations. They are promoting the literature, maybe culture, but they sell the tickets for a show. Then if that sale receipts exceed more than 20%, they are no longer charitable, though they have a 12 registration. That's how the income while auditing, be careful, because you have to fill up. The auditor has to certify it is eligible for exemption. So the income, when the books comes, one has to examine the nature of the income. So the exemption given is towards the objects have you incurred the expenditure. Towards the main objects, what is your income? So the ITR 7, now seeing so many difficulties from the CPC, I advise my staff and all other colleagues and chartered accountants, first you study the ITR 7. The ITR 7, the written form through which you are claiming the exemption, is having several schedules. The income schedules, 4 schedules are there. The expenditure schedules, 3 schedules are there. So how to bifurcate the income and fill in that ITR 7? So the income, corpus fund donations, voluntary contributions other than corpus fund donations, income from for the main activity, gross receipts from government, how much? So it is asking you the bifurcation. So the gross receipts out of sale of assets, how much? Because the normal capital gains computation is not applicable. The sale of assets, if you use for acquiring another asset, definitely that is the application. Automatically it's not going to form part of the taxable income. So the computation of total income on schedule is there in ITR 7. So right from the total income, right from the expenditure schedules, right from the income schedules, and there are several schedules. For example, if at all you are having accumulation, as we know, these charitable institutions or religious institutions, once they enjoy Section 12A registration, 2 types of accumulations are there. Form 9A for spending the money, surplus money in the immediately following year. Form 10 for spending the money within the coming 5 years for a specific purpose by a resolution. These 2 types of accumulations, the ITR 7 is asking you for the past 5 years, how many types of accumulations you have given the notice, and what happened to those funds in the year beginning, how much was there, during the year how you have dealt with it, and year ending how much is there. So the ITR 7 is asking. So one has to do the audit, keeping in view that ultimate result of audit is filling up the information, duly authenticated information in ITR 7. So the ITR 7 expenditure, it is asking you administration expenditure, how much, rent, electricity, like that it is asking. Auditor fees also separately it is asking ITR 7. So for such institution, so the administration expenditure, how many bifurcations are there, how much detail they are asking, and then towards the objective, how much. You may have several projects. Actually, the ITR 7 is asking you project-wise income and expenditure. You have a medical college, you have engineering college. So engineering college one separate project, medical college one separate project. It is asking project-wise the income and expenditure also. So the mistakes, common mistakes, what we do by unknowingly filling up, though you may do the correct audit, though you may know the principles correctly, if the information is not collected, collated, and filled up properly in the ITR 7, ultimately it may become a big problem. For example, the hundi collections, anonymous donations. So what is this hundi collections, anonymous donations? When you examine the income in this many parts, what the slide I have given you is a income for in this many parts, you try to bifurcate and then examine them. So the anonymous donations, though 12A registration is there, are taxable separately under section 115 BBC at the rate of 30%. What is meant by anonymous donation? If the donor's name and address is not available with the SSE, the recipient should receive with the name and address. You must prove. Better you in the receipt book itself, counterfile, you take his signature, or a covering letter take, I am so and so, I am giving you. Actually, this year amendment 2020 amendment is to avoid all this difficulty of the past. Every institution which is having ATG is given only for charitable institutions. For religious institutions, ATG is not given. Every institution which enjoys the ATG exemption, all its receipts, it should upload, just like in your 26 years banks, the TDS they upload. You have to upload the information, no TDS, but information. That is the donor's name, PAN number. You should upload. Then only the donor will get auto-populated his ATG donations list in his return of income when he is uploading his return of income. So the direct link, no manual filling up. Earlier ATG means so for example Tirupati, Tirumala, Annadhanam, everyone will come and donate some 10 lakhs, 20 lakhs, 5 lakhs. So after donating, they will get a receipt in which they will not have the PAN number. So So they go back, and while filing up the return, their auditor will call me saying, please give the PAN number of that institution to which I have donated. In the receipt, they have given somehow the PAN number is missing. So now this is avoided by this year amendment, saying that even if you receive per day 100 donations, all the 100 donations you have to upload with PAN number. Like that big burden on the big institutions, though they are doing genuine work, popular work, but they have to upload the donor's name, PAN number from this year onwards. That is the amendment. So the anonymous donations means the receipts which are coming from hundi collections, for whom charitable institutions. For religious institutions will definitely have hundi collections. For religious institutions, anonymous donations are not taxable. Only for charitable institutions they are taxable. So for charitable institutions, these anonymous donations, while filling up the ITR 7, it is asking you anonymous donations how much. So you must exclude it. Though you enjoy the exemption for the other income, for this one no basic exemption. So simply either 5% of the total donations or 1 lakh rupees, whichever is higher. So that 115 BBC limit only is there. So remaining anonymous donations are taxable. So while examining the income, which are the normal voluntary contributions which are not falling anonymous, and again voluntary contributions, corpus fund voluntary contributions, and other than corpus fund voluntary contributions, the ITR 7 is asking accordingly you bifurcate. Then incidental business receipts, separate books of accounts, because section 11 subsection 4A specifies any charitable institution, by chance it is carrying on a commercial activity, then for such commercial activity separate set of books of accounts are to be maintained, number one. Number two, they get them audited as per the business principles, and number three, that income if you apply for the main purpose, then you can enjoy the exemption. Popular example I give, in a hospital which is a medical relief, the hospital cannot sell the medicines less than the cost, cannot give the medicines free of cost, because if you start giving less than the cost or free, the local medical shop people also will go there and buy less than the cost of medicine so that they can get the profit. So you have to keep some profit margin and sell. Once you keep some profit margin and sell, because in every hospital, though it is a charitable hospital, only a registered institution, the books of accounts separately they have to maintain, purchase and sales they have to maintain separately. Most of the religious institutions are having hospitals. So, for example, Golden Temple is maintaining both allopathic hospital and Ayurveda hospital. It is maintaining. So they have to sell medicines to the patients. So separate set of books of accounts to maintain, get them audited, and such income you apply for a main activity only. That is for the hospital, say salaries and other expenses you are meeting with the income that you are deriving from the pharmacy shop. So then also the income is exempt, but provided separate set of books of accounts are maintained, and the ITR 7 also asks you to fill up these things. Next slide, please. So the income side examination is there, and similarly the expenditure side also one has to see these things. So now the income side, earlier 10(1) agriculture income is exempt, several other section 10 subsections were also to be enjoyed by the registered charitable institution. Now from 2015 onwards, this amendment has come. So the 2015 onwards, except 10(1) agriculture income or 1023C, now 1046, no other exemption is available. For example, dividends are now taxable, and from this year onwards, this April onwards, dividends are taxable, limited company dividends. For example, a charitable institution has invested in a government limited company and then derived some dividends. It can enjoy a 1034 exemption. So such exemptions, 1034 or 1038 exemptions are not to be claimed because they are given you specific exemption under section 11. So other than section 10(1), no other section 10 exemption shall be done. This is the 2015 amendment. So that's how I have given you this slide. So 1023C you can enjoy, and now also from this year by renewal, from 1/4/2020. Once you want Section 11 exemption, no question of 1023 exemption. Only 10(1) agriculture income you can enjoy because it's not within the purview of the central government. Next slide, please. So that is the limitation for Section 10 exemption. Now, expenditure side, one has to examine expenditure also, as I have already told you, revenue expenditure, capital expenditure. First, broadly, one has to bifurcate. Why? Because both capital expenditure is allowable as application. That capital expenditure must be for the objects. For example, an engineering college is there in a big 10 acres because it is the minimum requirement. The AICTE to give the permission, recognition for an engineering college, minimum 10 acres you should have. So the engineering college is having. For example, if it constructs an auditorium for its students, auditorium is also capital expenditure. So that capital expenditure is also if the income, revenue income, that is the surplus revenue income over the expenditure, if you use for acquiring the capital assets like buildings, auditorium, then also it is application which comes in the primary condition, 85% you have to apply. Gross receipts, 85% you should apply. In the gross receipts, maybe 60% you applied for revenue expenditure, 30% you applied for capital expenditure. Even then it is an application because the Section 11, 12, 13 say income applied if it is 85%, total exemption is there. So the word applied is interpreted by the courts to include the capital expenditure, which the department has accepted for the past several decades. So the capital expenditure, the ITR 7 also is asking you while computing what is the revenue expenditure, what is the capital expenditure out of the income, because you can incur the capital expenditure from 3 different sources. A, you would have raised a loan capital receipt from a bank. B, you would have received the corpus donations. Out of that corpus donations, you would have met this capital expenditure. 3, out of the revenue income, you would have incurred the capital expenditure. So the expenditure with the source also one has to link. How much is linked to this capital expenditure? If it is linked to income only, it is exempt. If it is out of loan, that capital expenditure you cannot come and claim as application. The word application is from the income. So that's how the expenditure has to be examined. In fact, the thumb rule is prepare the receipts and payment for the total year. Then bifurcate the receipts and payment account into compartments. Receipts matching with expenditure. Part A, Part B, Part C, like that. Revenue income, revenue expenditure, capital income, capital receipts, and capital expenditure. So like that, you try to bifurcate. For example, that sale of capital asset and purchase of capital asset. So a different capital asset is sold, different capital asset is purchased. That also has a compartment. Like the receipts and payment account, unless you bifurcate into several parts and then try to compute the income and then fill up the ITR 7, ultimately landing up with some trouble or the other. So that's how we should understand. So the expenditure, while we are seeing, the latest amendments are donations to other trusts as corpus are not allowed as application. That means one charitable institution out of its income, if it is giving a donation to other institution having similar objects, for the other institution, if you give a normal donation, it's an application. For the other institution, if you give a corpus fund donation, for you, the donor is not an application, it's not deductible. So that limitation one has to see. For the other people, because corpus donation is not taxable, and for you also, it's not. Some people used to do the tax planning. Whenever they have surplus income, give it in the month of March, and again next year you take from them another donation. So that loophole has been plugged by amending this thing. Similarly, payments to related parties is there from time immemorial in Section 13, 1C. Any payments directly or indirectly getting benefit to the persons who are linked. 13.1C is prohibiting the income, or say exemption, it is forfeiting the persons who are mentioned in 13.3. So in Section 13.3, the list of persons are substantial donors. Above 50,000 rupees donor is also a related party to it. So the authors, promoters, trustees, the executive, all the people are all related parties, or their interested party firms, their interested limited companies are all related parties. So if such transactions are there while auditing, one has to look into these types of payments separately noted. Now from 1920 assessment year, there is a separate amendment 40 capital A3 and 40 AIA, which are applicable for business entities while computing the business income. Mutatis mutandis have been brought into the section 11 exemption condition. That is, more than 10,000 rupees cash payments are there for expenditure. For payments, they said. So now the revenue expenditure and capital expenditure both will get affected, because we are claiming the capital expenditure also as application. So 48.3 limit will apply both for revenue expenditure and capital expenditure according to me. So how much such expenditure is there, that you have to, while filling up ITR 7 in 1920 assessment year ITR 7, a separate column also has been brought into what is the normal expenditure and the nature of this expenditure. There is a TDS, salaries to the temple employees, salaries to the college lecturers. So if you are not subjecting them to TDS, any civil constructions 194C contracts, any professionals TDS, all these TDS provisions, earlier TDS provisions, though applicable earlier also for every trust society, TDS provisions are applicable. In computing the income, they are not having the bearing. From 1920 assessment year, they are having the bearing. They have to admit this as a taxable income. So one should be careful while examining the expenditure from that angle also. So that's how I say. Now, in the given limited time, I will rush through other things, important things, and the latest 18, 19, and 20 amendments I will try to give more attention. So I will go through a little bit quickly. In the ITR 7 also, earlier years loans repaid in the current year shall be treated as application. There is a column in ITR 7. What is this earlier years loans repaid? That means an engineering college in the very first year, availing say 40 crores loan, has constructed a 50 crores building. So in the very first year, there is no income to claim any capital expenditure. So it has no revenue, it has got very little revenue income, and it applied that income for revenue expenditure. So it constructed the buildings. Whereas in the third year, fourth year, fifth year, when fourth year, when all the full strength is there, when it got some surplus, it repaid that building loan. To the extent the building loan is repaid, is an application. So in the ITR 7 also there is a column, one has to fill up and then say how much loan is repaid. Because only in the balance sheet item you will get it. In the receipts and payment account you should say that this loan, because you are not claimed the building as a application, building expenditure, and now that loan is now repaid. So that loan repaid definitely is an application. The ITR 7 also is. In the 11, 12, 13 sections, these things are not there. The ITR 7 itself is framed in such a way to accommodate the several court decisions. So the judicial precedents, so many decisions are accommodated in ITR 7. The department has given the recognition for such decisions thereby. So the loan repayment, though, is not an expenditure, it's a capital payment. Unless you look into it, the portion that is eligible for treating as application. Similarly, the expenses to specific caste community is prohibited. For example, in the expenditure, if it is for scheduled caste, scheduled tribe, or children of a particular age, definitely it's permitted. In 13(1)(b), a charitable institution is prohibited to incur the expenditure relating to a specific caste community. It is prohibited. That means the income will not enjoy the exemption if it is used for this thing. I have in one slide say how the department will take the view and how we have to counter. In the next we'll see. Please, next slide. So the income examination we have seen, expenditure examination we have seen, the objects class. For assessment year 18-19 onwards, it is a very serious amendment. In case any objects clause is modified or an adoption of a new object in the expenditure, in addition to the, while registering the institution, you have some objects, whereas while incurring the expenditure, you have taken up a new objective. That new objective may be a charitable objective. Yours is educational institution. You have taken up a medical camp. Medical relief is definitely is a charitable purpose, but it is not your objective. Once you incur that medical relief expenditure, you will lose your total section 11 exemption. So the from 18-19 assessment year, it is a very serious thing, and even now the subsequent amendments are based on this objects clause. Within 30 days of adopting or modifying, modifying means intentionally you have amended the objects clause. Adoption means by actions you have taken up a new objects clause. So in case the adoption or a modification of objects clause takes place during the previous year, during that previous year within 30 days, unless you apply for first registration, your existing registration is deemed to have been cancelled. This applies to 19-20 assessment year, 20-21 assessment year, and 21-22 assessment year also, because same rules are brought again, once again, in this first registration conditions, in case the objects clause is adopted or modified. So while auditing, while instructing the assessee strictly to which object, you have 3 objects. So the total expenditure for which object, which expenditure. In a vertical Excel sheet column, total expenditure only towards object, nothing. Objects and then general administration expenditure. So to administer, so to the total issue. Except that for any new object, if they incur the expenditure, definitely they are going to lose their registration, lose the section 11 exemption. So one should be very careful. Whereas casually we deal with the things in the sense, say for example, a religious institution. So a religious institution, for religious purpose, somehow directly or indirectly get related. A charitable institution, education institution, all the expenditure must be for education. So if it is for relief to poor, so old age home or some other thing, so that relief to poor you should fit into. So in that way, every object and expenditure must be specifically linked, then only it can enjoy. Normally the objects, new objects, if you want to take up, there is a section 92 of the Civil Procedure Code. It says a trust. Even the promoter, author of the trust cannot take up a new objective. He should go to the local court under section 92 of the Civil Procedure Code and ask the court permission. Sir, I am having a difficulty in pursuing the existing objects, or existing objects are becoming impossible for me. I am a trustee, I am holding the properties, I want to do the public service. The court will permit the adoption or change of that new object. Then alone one can, even such adoption, because the court is has given, not a voluntarily changed, you have to intimate to the Commissioner of Income Tax that in these circumstances new adoption is there. Then alone the income exemption can be claimed. Next. So the objects clause adoption or modification is such important thing. So there is an amendment in the section 115 from 17-18 assessment year onwards. We are having this accredited income, a new word is used. What is the section 115 TD? Section 115, as we know, is a rate of tax, not computing the income, a rate of tax section. In that rate of tax, they brought a new rate for these charitable institutions which are losing their exemption by virtue of this objects clause amendment, or some violation is there. Because of such violation, they are losing their recognition, they are losing their exemption. Means on the market value of their total assets, they have to pay 30% tax. This is the market value of the fair market value of the assets of such a religious or charitable institution. Because it lost its registration, is becoming taxable income. The word given for that taxable income is accredited income, section 115 TD. This is definitely a very harsh section, so one should be careful about this. Otherwise, say 10 years back, 20 years back, you acquired a land. For example, if it is out of agriculture income acquired land, is all right. If it is out of donations you acquired the land, definitely that land's market value you have to pay 30% as tax as per these sections once the institution is losing its registration. So one should be very careful. If it is transferring its assets to some other institution also, which is not having the similar objects, then also it becomes a accredited income. So one should be very careful. So this accredited income every year, whether are we falling within these negative conditions, in the sense losing the exemption, losing the registration. So if it is falling within this 115 TD, there is a conversion of into any form which is not eligible for registration of 12A. That means if you convert the institution or merge with any entity which is not having 12A. So failure to transfer all its assets at time of winding up. So in all such cases, it amounts to the accredited income. If it is accredited income, it's very dangerous. So next slide. So the accredited income is taxable. So at the rate of 30%. And if the 12A registration is cancelled, 12A registration, when it can be cancelled? 12A registration can be cancelled if directly or indirectly its income is used for the benefit of those section 13(3) mentioned persons, related parties, or if it is not used for the objects for which it is promoted, or the genuineness of the activities is doubted by the department. Then in all such cases, the existing 12AA subsection 3, existing 12AA subsection 4 gives the circumstances in which the Commissioner of Income Tax can withdraw the given registration by giving a due notice. So including this modification of objects. So in all such cases, once the registration is cancelled, then automatically from the day of cancellation within 14 days, it becomes an accredited income unless it is appealed and successfully come out. Otherwise, say within 14 days, the income will become, that is what the income, the fair market value of all the assets is the income, accredited income, that is taxable. So this much danger is there for every charitable institution and every religious institution, public religious institutions, public charitable institutions. They have to be very careful not to fall within the clutches of this section 115 TD. Next. So here the default for these institutions is the trustees are how to compute that income I have shown here. So at the fair market value I have already stated. Next. So the who is the assessee in default means in this 115 TD. The trustee is also personally liable. That means the trustee is not paying the income tax. Then the trustees also have to pay from their personal say assets the tax liability for this accredited income, because the trustees individually also are treated as trustees in default. Next. So the computation of income has to be taken very carefully, both the income side, expenditure side, the with a view to comply the law and not to violate any of the provisions. So next slide. So this 115 TF is part of that TD, TE, TF. So then what is income and its application? So normally, as I have explained you in the past, that the interest on corpus fund donations is also income. Some people try to add it to the liability side of that fund. So it's not the correct thing. So the case law says that interest on corpus fund donations, though you make it as bank FDs, the interest is a normal income. So revenue expenditure for the objects what you incur, for general administration what you incur, and for the objects you incur capital expenditure. That means if an engineering college constructs shops near this compound wall, near the main road, the shops expenditure you cannot claim, shop buildings expenditure you cannot, because it is not your object. So by taking up that activity, that expenditure will not become income applied. If you construct an auditorium, definitely. If you construct classrooms, it is a capital expenditure for your object. So the capital expenditure also shall be for the objects only, not for other than the objects. You should incur the capital expenditure to claim it as application, because every year out of 100 rupees income, 85% expenditure, 85% must be applied. There is revenue expenditure account. If there is shortfall, then the accumulation process, as I have already told you, is within coming 5 years for a specific purpose. For example, a hospital is there. It wants to buy an MRI machine, which costs say 5 crores. So in 1 year income, surplus income, it cannot save and buy that machine. Maybe 4 years it will accumulate, and then 5th year it will buy a scanning machine. So like that, for a specific purpose you can accumulate, then you have to apply through Form 10, that is known as Section 11(2) route. And whereas the immediately following year for general purpose, any of your objects purpose immediately, then Form 9A, it is known as Section 11(1) explanation 2 route. So 2 routes of accumulation are there. So accordingly, the income has to be applied or deemed to be applied. So the income, once you give the accumulation notice, the deemed to have been applied. So the ITR 7 specifically asks, what is the deemed to have been applied, how, what purpose? And the most important thing is, once you say accumulation, shortfall is there, that money you should keep in a specific bank, that is 11(5) mode investments, normally bank FDs. So that 11(5) gives a condition list of investments to be made, deposits or investments. So once your income is accumulated, that is 11(2) or Section 11(1) explanation to Form 10 or Form 9A, the ITR 7 specifically asks, this accumulated money in which bank FD you have kept? Because in the subsequent years, 3 years, 4 years, the bank FD should be intact. Once you withdraw, it should become application. Specific FD, 4 years you are having 4 different FDs. For a specific FD, specific year, specific object only, you should withdraw and apply. If you interchange or do something without the permission of the assessing officer, then you are violating and you will lose your exemption. Though you do the charitable purpose, the strict condition you have to fill up, and then most of the people forget about this. So generally they take all the money is there in all bank FDs, all are nationalized banks, no problem, no. Specifically, once you have accumulation, you should give this. In the ITR 7, it is asking you to fill up the columns, and then it will monitor year after year. So in the 3rd year, it will say you have withdrawn the FD, FD is missing, whereas you have not applied for the specific purpose. That's how it is there. So what is business incidental? So that is also Section 11(4). So the education, medical relief, relief to poor objectives, the incidental business is permitted. That means which is necessary. For example, a college is selling books. College has prepared its books and it is selling. No doubt it is selling for profit. Definitely, it's an incidental to main educational activity. As I told you, the hospital selling the medicines. So the incidental business is permitted. It should be an incidental business and not a unrelated business. If it is incidental business, definitely it is permitted. That's how separate set of books of accounts are to be maintained. For example, an engineering college is running buses. It is not having its own buses. It hires some buses and collects the bus charges from the students. If it is resulting into surplus, definitely year after year, it's going to be a separate business. Separate books of accounts are to be maintained. That's how the income and application words. So that business income, once again, you have to use for main object, then alone. So that's how I have given you the case laws. Next slide. So the income and application, how you should do. So now the question of depreciation. So from the 15-16 year, earlier, out of income, if you acquire a new asset, its cost is claimed as application, and subsequently every year its depreciation is also claimed. So the department thought, the government thought that you are claiming the cost of the asset once, and subsequently it's also you are claiming the depreciation. It amounts to double deduction they don't want to give. So they amended the section, brought Section 11(6) amendment, what it says, choice is given to the assessee. Either you claim in the year of acquisition of that capital asset, out of your income if you have acquired, you claim the cost of the asset. Then, though for accounting purpose true and fair, you may calculate the depreciation. For computing the income, no question of depreciation. Second option, in the initial year in which you have incurred the expenditure, no cost of that acquisition of that capital expenditure is claimed, then depreciation is eligible. Either this or that. So this is how you should do. So what we have to do? Up to 14, 15, on which assets you claimed the cost as application, those assets you keep separate. For some assets you could not claim, as I told you, the engineering college first year building is there because it is out of loan. So that building still, because you are not claimed the cost of the building, even now you can claim the depreciation. So two sets of fixed assets from 15, 16, those fixed assets whose cost is claimed, those fixed assets whose cost is not claimed, separately two portions you have the schedule, sub-schedules like that in the fixed assets depreciation schedule. Thereby, eligible depreciation only you claim, ineligible depreciation it is allowed. Next slide. So this is the double deduction is there or not, one has to be carefully look into it, then only you can do it properly. Next slide. So the depreciation part, one should be very careful. Even now the option is given. So the section 11.5 and 13.1d, section 11.5 says the investment surplus funds, the property must be within 11.5 mode only. If you are not having that 11.5 mode investment, definitely you will lose section 11 exemption. So this where that losing is there in section 13.1d it is saying, and the auditor has to certify in the annual accounts that yes, we have complied with 11.5 and we have not violated. That means throughout the previous year, no investment is made other than 11.5. That means RBI not recognized bank, a private bank which is not recognized by, say, let us say, not a scheduled bank, not recognized, it is a scheduled bank. RBI gives permission for every bank, but if it is scheduled bank only, nationalized bank and scheduled banks are covered by level 5. Not scheduled bank means it's not covered by level 5. So similarly, if somebody donates, yours is a religious institution, somebody donates some private company shares. So this religious institution within 1 year from the end of the year must convert those shares into cash and then say make a bank FD like thing acceptable in section 11.5 acceptable. Otherwise say it lose its exemption. Next slide. So that section 11.5 and 13.1d, one should be very careful. Exercise the option for deemed application of income. As I told you, section 11.1 explanation 2 is for the immediately following year. So for general purpose, any objects, any purpose you can, because in the month of March you received the donations, you cannot use it for charitable purpose in the month of March alone. So in the immediately following year, if you can apply, then you go for this form 9A, which is electronically to be filed from 16/17. Lot of questions, lot of complications come. This form we have forgotten, sir. Form 10 we have forgotten. Form 9A we have not forgotten. So then the CBTD in 2019 and 2020 has come out with several circulars saying that even the delayed filing of Form 9A or Form 10 can be condoned by the Commissioner of Income Tax. So that's how they have given. So that part we are going to see shortly. So this accumulation, exactly calculate and try to through that form electronically filing and claim it properly. That's how one should be careful. Next slide. So this one type of accumulation mode, and Form 10 is the second type, 11.2. So that is nothing but within the coming 5 years for a specific purpose. Unlike 9A for general purpose, here for a specific purpose it has to mention in the form. This also to be electronic. Please note that these two forms also from 16/7 are to be filed electronically along with the return of income. So the charitable institution or religious institution to claim section 11 exemption or section 10 exemption, within the time the return has to be filed, that amendment has come from 18-19 assessment year, return has to be filed within the time. But before this itself, the Form 10 and 9A from 16-17 assessment year itself, what the amendment has come, within the due date of filing of the return of income, you should have filed that accumulation notice. So overall, the business return, a limited company with multi-crore turnover, if you are not filing within the due date, anyhow it is having taxable income before the completion of the assessment year, end of the assessment year, you can file the return of income. Whereas for a public charitable institution which wants to enjoy the exemption, it has to file within the due date its return of income, A, with the duly correct audit report, B, with the due Form 10 or 9A electronically to be filed. So all these things within the due date, if you are not doing, it results into taxable income. So that much danger is there. So this is the second type of accumulation. A resolution is necessary. The purpose has to be specified. That purpose must be one of the objects purpose, specific purpose. Vague purposes if you write, then also they can deny that Form 10 accumulation. So once you have this in the ITR 7, for earlier years, how many earlier years spending, for current year, how much you are claiming, where you have kept this money, it will ask. Next slide. So, so the secondary accumulation Form 10 were given, and then for example, if the within the due date, if you are not filing the Form 10, it will be rejected. For that, the CBTD surplus, as I told you, 139(1) due date, because the section 13(9) specifically says, section 13, as I told you in the 11, 12, 13, section 13 is negative condition. That means if you are not satisfying this condition, you will lose the exemption. In one such a thing, the amendment has come from 16.7, 13.9, which says within the 139(1) due date, you have to file this Form 10. So for that, the difficulty has been identified the CBTD, and CBTD has given the circular number 7 of 2018, saying that the delay can be condoned by the Commissioner of Income Tax Exemptions. So that's how this is there. So next slide. So the accumulation of income is a very, very important thing. On this, number of circulars have come. Another thing, another slide I am going to tell you. This is a carry forward expenditure. It is not there in the ITR 7, but number of court decisions have come. That means in the earlier years, if you have incurred excess revenue expenditure, not the capital, in your income and expenditure account, not the depreciation, the actual expenditure, the excess expenditure if you have incurred, I have given you this 2017, 2016 latest decisions, there are 2018 decision I have given. Still the courts say that after all it is a charitable institution, it has incurred in 1 year excess expenditure. So in the subsequent year, if it is having surplus income, though there is no carry forward benefit like losses to be set off like provisions applicable to these charitable institutions, because it has to meet its both ends. So the earlier year excess expenditure can be set off against the subsequent year income. So please be careful, not the computation of capital expenditure like that excess expenditure. It is a revenue expenditure that is to be understood. For this, there is no column or provision in the ITR 7. Normally, CPC will reject it. But anyhow, through 154 or before representing before the assessing officer, one can establish this claim. So excess expenditure still is eligible, and as per the court decisions, one has to claim as application in the subsequent year. In the subsequent year, it is not actually incurred, but earlier year incurred, because it is excess expenditure. There is no income in the year in which it is incurred. So subsequently, in the second year, it can be claimed. Yes, next please. So next slide. So section 115 BBC, I have already anonymous donations. So try to avoid anonymous donations, otherwise say anonymous donations are becoming taxable. The filing of return of income within the due date is mandatory along with the audit report. This is from 18-19 assessment year. For this also, though the section says within the due date means 139(1) due date, the CBTD has given a clarification saying that instead of 139(1), 139(4) due date, that is, if the return is filed before the end of the assessment year, definitely the return can be taken as if filed within the due date, so along with the audit report. So the section specifically says 139(1) due date, normally September 30th, but the CBTD liberally has given a circular, which I am going to show you in the next slide, that before the due date before the end of the assessment year, if you are going to file the return of income also, you can claim. But try to avoid the belated filing of the return, because a business return you can file a tax audit return after September, but this tax audit of charitable better complete even this year 2020. We are in June. Maybe we have the COVID difficulty, but all the charitable institutions, audit must be completed, returns must be filed before 30th September. For a normal non-tax audit individual return, they have given the November 30th as due date. Whereas the tax audit, especially the charitable trust, even now they have not extended the due date. So the September 30th is extended only up to October 31st this year they have extended. Whereas the non-tax audit up to November they have extended. So this year, before October 31st, within the extended due date, one has to file the return. If you don't file the return with the audit report, what will happen? Though you have a total registration, the exemption, section 11 exemption is gone. Once section 11 exemption gone means all your purposeful donations are taxable, ordinary donations are taxable at a gross value, not after deducting the expenditure. So this is a very serious thing. So filing the return of income, completing the audit, and the audit is examining the expenditure, examining the income, as I have told you. That's how it has to be done. Yes, next slide. Quick. So this is the substantially financed. This also I would like to tell that all the universities, as I have already told, any medical institution or educational institution which is substantially financed, that means the government has to finance. So if the government finance, what is meant by substantial? 51% or more. The earlier courts were ruling that what is meant by interpreting substantial finance. Then the rule is introduced a few years back, saying that from 1617 the return has to be filed 51% or more if they have their income substantially financed by government. They do have to, though unconditionally their income is exempt from 1023C, small 3, AB or AC, like universities, like government hospitals. If it is a separate institution, so a body by itself, so then it has to file the return of income. So that's how the section is amended. 139(4)C subclass E is amended. So the return has to be filed. Next. Time is short, we are running out, so we'll quickly go through the other amendments from 1819 assessment year. The other amendments, that is the 80Z limit is reduced from 10,000 to 2,000 rupees, and all the conditions for this 12A have to be fulfilled. That is including the objects clause, as I have told you. Objects clause adoption or modification, if it is taking place from 1819 assessment year, unless within 30 days they apply for fresh registration, the existing section 11 registration goes. And then 56(2)10 is also the new amendment, that is without registration of 12A or approved under 1023C, any capital receipts automatically will become the other source income under 56(2)10. The expenditure also, as I have told you, one should be very careful. And then 269ST, the 2 lakhs rupees donations limit. So whether for capital receipts or revenue receipts, for example, a student is paying a fees for 4 years, he pays the cash, then automatically 269ST even for such institution will apply. Donations also, the religious institutions, if they receive 269ST 2 lakhs rupees limit will apply. So it applies including agriculture. Many big religious temples, they may have big agricultural lands, huge agricultural lands, agriculture income. If they receive by cash, 269ST penalty will become. Though the income computations are not there, the penalty is also a difficulty. So one should be very careful in looking into this. Next. So the 2018 Finance Act, some amendments made applicable from 1920 assessment year. So that's what I said, 40 capital A3 or 40 IA, and then TDS provisions, as I told you, they have to comply, and then because they said mutatis mutandis it will apply. In the subsequent year, you comply that deficiency of TDS 40 IA. Maybe that year once again you are eligible to claim what you have disallowed and offered for tax. Maybe you have to claim that expenditure. So amendments, these amendments are all most important amendments for 18-19 assessment year. Next, please. Next slide. The 2019 Finance Act amendments are very important amendment. Not only under the Income Tax Act, under any other law, if you violate also, which is having a bearing on your main object. So in my view, for example, an educational institution offering education to society, its main objects. The commissioner has given to lay registration. The state government prescribes fees for the school. This much fees only you should receive. More than that you should not receive. That means some other law is prescribing some limits. If it is a violation identified under that law and that violation is finally confirmed, even in the appeal, so it is proved that the institution has violated some other law which is having a bearing on the main activity, main object of this institution. Once such violation is there, A, it will lose its income exemption. B, it will lose its registration. Even at the time of granting a fresh registration, the commission can ask, have you violated in the past any time? Is there any proceedings? If you give an undertaking, yes, I have not violated anything, it's all right. This amendment is effective from 1/9/2019. So this amendment last year has been brought in such a way that majority of the institutions unknowingly, if they are violating something, and then such violation is brought to the notice of the Commissioner of Income Tax, who is the registration giving authority, can cancel the registration and the income shall be, it is no longer a charitable purpose, and definitely it is going to become a very big burden. This is the amendment. So Income Tax Act is referring to some other law, some other provision where such violation is becoming a hardship and it is losing its exemption. Next. So the Finance Act 2020 amendments, now quickly we'll go through. So the Finance Act 2020 amendments are, I have already explained you that either of these things, either one, only one, either 12AA, which is replaced by 12AB, or 1023C, or 1046. Either of these things, one of these things only you have to take, and existing registrations shall cease to be registrations within 3 months from the amendments becoming effective. They said June 1st, they earlier said. Now, because of the ordinance, they postponed the date to October 1st, 2020. That means till September 30th, you file the return, or say it is valid till October 31st, the extended date of filing the return. So for the assessment year 2021, no problem. For 21-22 assessment year, unless you apply and get a fresh registration, so it's not going to be. So that fresh registration application form had to be notified. They have to give a specific form. In that, definitely they are going to ask so many new things. So then only they will give the fresh registration. So their intention is to examine more thoroughly at the time of registration itself, and every 5 years again and again will be coming up whether you have complied with the law or not. That is their intention. So then before the end of that 5th year, that means 6 months prior to the last ending of that 5 years period, again one has to apply for renewal. Hitherto not registered institution means for existing institutions they will give fresh registration for 5 years. There is no, you call it as renewal. Whereas a fresh registration without any earlier registration, if one applies, then it is a fresh registration. Fresh registration is going to be a temporary registration valid for 3 years, and within that 3 years, before the expiry of the last 6 months, one has to apply for again renewal, or if it is commenced its objectives, activities as per its objectives, within 6 months it can apply. So now also the old law, whether it is a renewed one or a temporary registration or permanent registration, during this period also, if the objects are changed at any time, within 30 days, once again you have to apply for fresh registration. For ATG also, earlier it was a permanent ATG, now they have restricted to 5 years only. So same, just like only every once in 5 years you must apply for renewal of ATG, and the uploading of the donations also is the new amendment, as I told you. So from 1/4/2020, all the receivers, the donees, the institutions which receive as a public charitable institution or religious institution must upload the, if you are not uploading also, late fees, all the penalties are included. So the registration cancellation powers, earlier under 12AA3 and 12AA4 were there. Now under 12AB also, the same violations are going to be taxable. Next, please. So we are going to the condonation of delay. What type of delays are there? As I have already explained you, 3 types of delays can be there. A, the return is not filed within the time. B, the audit report is not filed within the time, because the return must be accompanied by audit report. Who has to file the audit report? The assessee who has to file the return must obtain the audit report from the auditor online and then attach it with the return. In some of the cases, though practically the auditor may help the assessee in filing the return, this audit report is missing, somehow it is not linked. Then these genuine hardships they have seen. So in case of 10B or 10BB audit report not attached along with the return, for 16, 17, 17, 18, 18, 19 delay, one board circular is there. That is 22/5/2019 board circular. Please go to the circular. Under section 119(2)B, the Commissioner of Income Tax is authorized to condone the delay and then make them, because without audit report the income cannot become exempt, because it is a condition in section 11 that unless the accounts are audited, where the basic limit is exceeding the 2.5 lakhs is exceeding the gross receipts, unless the accounts are audited, section 11 exemption cannot be given. So you have really done the audit, you have uploaded the audit report to the assessee. Assessee while filing the return has not attached this audit report to the return, then they will lose the exemption. For that they have given. So the first board circulars are for 16, 17 to 18, 19, and whereas now for 19, 20 and subsequent years, the limitation is given 365 days delay only can be condoned by the commissioner. That is the latest board circular. That is a circular number 2 of January 3rd of 2020. 365 days limitation is given. Next slide. So the audit reports delay. Now return filing delay. For this also board has given the circular. And after this amendment, some commissioners, some assistant officers said, you have filed the return belatedly, so I am not going to give the exemption, section of exemption. So I have given you this Cochin Tribunal decision for a Calicut case, where they said this amendment after that only from 1819, if the return is delayed, the assessing officer can say if there is no condonation of delay. For earlier years, even the return is delayed, exemption cannot be denied. That is the case law. So the circular, board circulars I have quoted here, that is the CBT has given in April 23rd, 2019, that even if the return is filed before the close of the assessment year, you please give them the benefit of exemption. Not necessarily, because in the explanatory note to 2018 Finance Act, in the explanatory note, they simply said the return has to be filed within 139 due date, 139 time. They didn't say 139(1). Now the interpretation, the board itself has accepted saying that, because we said 139, not necessarily 139(1), even 139(4), a belated, that is before the close of the assessment year, the exemption shall be given. This is the useful thing. So many of the difficulties can be sorted out if at all they were there. Now next slide is Form 10 and Form 9A delay. This is the third type of delay. So many could not file within the time. So it becomes a taxable income, because without accumulation, instead of 85% you applied only 70%, 15% you Form 10, you thought you have filed, it is not filed. So similarly Form 9A. So, and actually for this also the board circular also says, to the extent of that accumulation, the fund must be there in a particular bank FD. So where you have deposited as per section 11(5). So for this you are having 4 circulars right from 2018 to this 2020 19th February latest circular also, which all these circular summon substance is by mistake they have not filed form 10 or 9A within the time. The commissioner is having the power. If it is due to a reasonable cost and if it's a genuine case, definitely you try to give it. Even if the return is delayed, return delay one condonation separate, and along with the return this form 10 is also delayed. Both the delays you can condone, not one delay alone. So that's how the last bottom line process is. Even if the return is delayed, that delay you condone and this delay also you can condone. The commissioner is given the power to condone the delay, and thereby the electronic filing of return, electronic filing of 98 and 10 though introduced in 2016-17, majority of the senior auditors, they may not be familiar with this electronic filing of form 10. Return they would have filed, form 10 physically they would have filed, or physically they would have posted. So many types of mistakes would have taken place. All that the board has considered the request thousands of people, because meanwhile the CPC has raised the demands. So in all such cases, the liberal consideration has been done by the CBTD, and this many circulars have come. So one has to take use of these benevolent provisions and then try to see that the charitable purpose objective will not get defeated by paying the tax unnecessarily. Next slide. So we'll go to the question answer. The 2-hour session is coming to end. So we'll go to the question answers. So Chairman, if questions are there, I will take questions for 15 to 20 minutes. I will take the questions. So you please pop up the question. So the question is from Pragadesh Khanna Murugadas. Let us assume a trust has applied for 12A registration and started collecting donations from the date of application. 12A is granted on a later date. Will the amount received in between will be taxed? No, actually, the 12A registration, if at all it is granted in pursuance of an application, from the day the application is made, it shall be granted, not from a subsequent date. The provisions say, as I have already elaborated in my speech, during the previous year, any day you apply, if once the registration is given, from the first day of the previous year, registration shall be effective. The act has been written. The statute specifically says from which date the registration is effective. For example, 1920 is there. You have applied in 20 March. You have started in 19 April the collection of donations. They give in 20 September the 12A registration. All the donations you received from April 2019 onwards are exempt. This is the answer. So act is very specific, not from the day they grant the registration. The order is there, but from effective from the first day of the previous year. So that's how we should be. Next question. A charitable trust running an education institution claiming exemption on Central 3 small 38. That is below 1 crore. So far wants to get registered. Can such trust go for new registration? It has to go. If it wants, now you please take. Even now you apply. Actually, the amendment in this 2th year budget is 2020-20 budget is, as on this budget day, pending applications, the new provisions will apply. Anyone who applies now, 6 months time is there. Within 6 months, the new provision will come. So all the pending applications, the new provisions will apply. So to be on safer side, you don't know in which year the 1 crore will cross, because for 2020 March, you are having below 1 crore. Now 2021, it may cross 1 crore, you are having that apprehension. Then better you apply now itself 12A, no problem. So even now the 12AB will come into effect from only October 1st. But now 12A application you make, based on this pending application they may give for 2021 total financial year, the exemption. So automatically you will get it. So it is better you please apply. That's what my suggestion is there. Don't wait up to October 1st, 20. So that's how you should enjoy the exemption by registration. Next question. Is the amendments in 2020 now operational from 1st June? So as I told you, the renewal new procedure of registration only is postponed from 1st June to 1st October. The other amendments, all amendments what they said are applicable from April 1st. So one should be very careful that there are 7 to 8 amendments for the charitable institutions. So only this renewal time limit is first stated as 1st June. Now because of COVID, it is going to be 1st October for the existing institutions to apply for fresh registration. Or those institutions which are not having any registration, they can apply provisional registration. Freshly started, newly started charitable institution or religious institution, from the day it started, it can apply for temporary registration, that's the registration. The forms itself, they have not yet specified. So don't wait up to October 1st for this thing. So whereas the other amendments, what they said for 2020, as I have shown in my slide, they are applicable from the financial edition, because the finance bill placed before Parliament on February 1st has become an act by March 31st. So once it has become an act, other amendments are applicable. That's all the answer is. Yes, please. Next. Next question. A charitable trust registered with SRO in the year 2015-16 but has not filed its return of income for the past 3 years. The trust now wants to register on 12A, which is from 110. Will the CIT ask for 3 years ID copies? Definitely. Income tax return copies. It seems you have not joined from the beginning my lecture. So it seems I have given elaborately 15 minutes time for this question. The answer in my speech, Mr. Razu Venkatachalam. The last 3 years audited accounts is a must. Return filing is not a must. So because it is registered as a trust, whether there is income or not, some expenditure is there or not, some activity is there or not, through audited accounts. Because now you are filing Form 10A online, it asks last 3 years audited accounts. It is not asking you last 3 years income tax returns. So first you get them audited, even now, and then attach them and file it. Not necessarily the income tax returns. This is the answer. I have already elaborated. Yes, next question. ITR 7 schedule ER, expenditure revenue ER. So establishment administration expenses, that is part A. Expense on the objects of the trust, part B. Yes, if education is my object, can I fill the entire expenses incurred on running a school in single line item? That is part B. Yes, you are right. So the school principal salary, the school rent, they come in objects expenditure. If the society is having some other rented premises, that rent comes in establishment administration expenses. So the expenditure, telephone expenditure, the school telephone expenditure is for school education expenditure. If the society is having a separate telephone for its administration office, then it becomes administration. So the expenses bifurcation, as it is asking in the schedule, you must bifurcate into objects expenditure and establishment. In the establishment expenditure, further bifurcation is there. If you have establishment and administration, then you give the bifurcation. For objects, there is no bifurcation. You give that total expenditure as thing. This is the answer. Next, sir. Section 8 Company under Companies Act yet to obtain 12A started activities. Whether the gross donations received will be taxed or not. So, two possibilities I am giving you. A, any 12A registered institution, whether it is a trust under Trust Act, society under Societies Act, or a company under the Companies Act, if it is not having 12A, if it is filing the return, under normal 5 heads only income has to be computed. So under normal 5 heads the income will be computed if it is having, it is not having 12A registration. Second option I am giving you. You don't want to pay the tax because it is a genuine charitable institution. Unnecessarily, why you want to pay the tax? So it has started as a company. Now last 3 years accounts audit. Don't file the return of income. Attach with 12A, Form 10A. So now you try to get the 12A registration. If you get the 12A registration, last 2 years, 3 years, last 6 years income, if it is really used for charitable purpose, the gross receipts will not become taxable because you have complied, 85% you have applied. Then no question of earlier years, gross donations becoming taxable. If you are not going to get 12A even now, then if a 148 notice is given, earlier years will be opened, not the net income, gross donations will become taxable. That's how The two routes are there. Better try to save the tax. Better at the earliest get 12A registration. If you keep silent, definitely based on the 360 degrees information the department is having, all the bank accounts, all the financial transactions, just like that the officer will get. Then they issue a 148 notice for early deeds also. Then gross receipts donations are taxable, not the expenditure. Yes, sir. Next question. The objective of a trustee is wide, say about 20 objectives. Out of 20 objectives, trustee is carrying out activity in one objective in 2019 and another objective in 2020. Very good. If you have a 20 objectives, the income tax commissioner is entitled to not to recognize this as a charitable institution. Supreme Court decision in the case of Ganga by Charities, you please see vague objectives. All the 20, can you carry on the objectives? If you are not able to carry on, why you have these 20 objectives? Just like that fancy. So write too many objectives. Not more than 5 objectives you have. If you want a real registration, not more than 5 objectives you have. That is my advice, practical advice. It's not there in the act. My practical advice is be practical. You can take up 5 objectives. Why do you want 20 objectives? That means you are not a genuine charitable objective person. So just like a casual person talking, the Supreme Court has said, if the objectives are that way broad, not practically really taking up, registration can be cancelled, registration can be refused. The Gangabai Charities decision of the Supreme Court. So first amend your objectives. What is practically possible? Try to have those objectives. All the remaining objectives, delete. So with the codicil, you write, if the trust deeds are there, if it is a society, convene a extraordinary general board meeting, reduce, prune the objectives, have 4 or 5 objectives which are really genuine. Out of that 1 or 2 take up, then you apply for registration. Definitely you will get the registration. If you have too many objectives and objectives writing also, some people meticulously write day-to-day activities. Bank account shall be operated. It's not an objective, it's a day-to-day activity. So what is objective and a specific objective, not a vague objective. There are a number of rulings about these things, so one should be very careful. So if you want to take up 2-3 activities, restrict your objectives list, first amend and then go accordingly. So this is my answer. Next. Objective of 2019 is not carried out by the trust in 2020. Will the trust lose registration in 2020? No, if you are having already 12A registration, for one activity you have taken up in 2019, another activity you have taken up in 2020, no problem. You are already having registration. But when you go for renewal, there may be a problem. This many activities, objectives you are having, you are not pursuing. So why you are not pursuing? Are you genuine? My question is, if you are a genuine one, why you have this many objectives? The commissioner can examine the power while granting the registration genuineness of the objectives. If you see 12AA subsection 3, which is now mutatis mutandis 12AB, the amended new objective also. So have genuine objectives which you are really carrying on. Because 1 year one objective, second year another objective, that cannot be the reason for cancellation of registration. That cannot be the reason. This is the answer. Next. So can a charitable trust invest in excess funds 15% in shares and mutual funds? So the section 11.5 says its property and funds must be as per section 11.5. It is not saying whether it is after applying 85%, 15% you can do as you like. It is not saying. For that 15% also, this 11.5 will apply. 11.5 is having a big list. 11.5 in the Act is having around 15 types of this thing, and through notification rules, again it is having another 15 types of investments. For example, in this Act given in section 11.5, immovable property, jewelry, furniture. So bank FDs, post office FDs. Again, if you go to that mutual funds and shares, government company shares, government company deposits, government company debentures, government mutual funds. Definitely you can have government securities, G6. You can have it. So go through that 11.5 section and the notified investments. So whether it is within the 15% of the excess funds or general funds, Even a bank account, ordinary account, savings bank account also, strictly as per 11.5 only one should have. There is no distinction between, you can do 15% as you like, nothing is given in the act. Separate bifurcation is not. Yes, next question. If cash is deposited by a donee directly into the bank account of the trust, will do 100% will apply. So some donee with his name and address who can establish has deposited 3 lakhs rupees. Better you pay on 3 lakhs rupees to ST penalty. So even if he has deposited, these are all hypothetical. So he is not interested in getting to ATG. So he wants to donate. So let him donate. And if he is not knowing the provisions, definitely the trust which receives it, definitely has to pay the penalty. The act is not distinguishing, see, whether you have done it, you have received it, or they have given it voluntarily. Strictly to 16 ST simply says any single transaction more than 2 lakhs rupees attracts any person. It didn't say charitable trust, an individual, a company. It applies includes to agriculture income. The board after for a specific FAQ, specifically board as the GBT has replied. This applies to agriculturist also. An agriculturist is not an income tax say. For his agriculture income subscription, ST will apply. The board by a specific clarification has given. And that much is the stringent law. We cannot take leniently. This is my next question. So it seems questions have exhausted. So yes, Mr. R. Maheshwaran. Sir, if the option is exercised for accumulation but could not be spent, what is the consequence? Sir, you have exercised the option for 5 years. You have kept the money in the bank FD. In the 5 years, you have not touched it. 6th year, it will become the income. Automatically, whether you withdraw the FD or not, 6th year, it will become the income. So the option is exercised for accumulation. Definitely, you would have kept the money separately, so that much income in separate bank account. But after 5 years, you could not use it. 6th year, it will become the income. That is the law. Number of case laws are there, and this is the position. Yes, sir. Or within that 5 years itself, you have withdrawn, in the sense, I don't want to go for the option. In the year in which you have withdrawn the money, that means in which you are not going to say it is accumulated money, then in the year in which you have withdrawn, it will become income. Say, Maheshwaran, can we use the corpus donation for any capital or revenue? 100%. The corpus donation, if it is not a specific donation for land, for building, for land fund I am giving, for building fund I am giving, for library books fund I am giving, then you must use it only for books. But temporarily you have no money for salary. For salary, electricity expenditure, if you are not there, where is the question of buying the land building? Then you pass a resolution saying that though it is a corpus fund donation, we cannot keep this in the capital asset because now the revenue, as and when we get the surplus money, we are going to use it for the specific capital asset acquired. Temporarily we are using it for revenue. You pass a resolution and then use it, no violation, nothing is there. This is the answer. Next question. So, can trust collect donations up to 2 lakhs rupees from a person? No problem. See, the donor more than 2,000 rupees if he is giving cash, the donor cannot claim ATG, though the receiver is having ATG benefit. You cannot give that ATG benefit to him because more than 2,000 rupees. Up to 2 lakhs rupees cash collecting is not a problem. The charitable institution can collect, a religious institution can collect as donation. It should not be charitable institution, not an anonymous donation. The donor should say, I have given the donation as cash. So get a confirmation from him, and up to 2 lakhs rupees, no problem, you can have cash. But the donor cannot claim any ATG benefit because ATG is amended only to have 2,000. Earlier it was 10,000, that also is reduced to 2,000 rupees at par with the political party. Yes, please. Next question, please. So school running for the past 20 years not registered. Can they register for 100%? You please apply for a registration. No problem. So the government wants all the people to come fall in line. For past 20 years, maybe below 1 crore in initial years, maybe it crossed 1 crore also. Don't worry. In the early year, you have no registration, you have not filed the return. But now regularize. Past 6 years, you please get audited. Only 3 years audited accounts, attach and apply for registration. Definitely, you can get the exemption. Government wants to liberally use the registrations. So this year amendment, they want to be careful, but at the same time, they don't want this bureaucracy to hold the registrations. People should come liberally for registration. Everyone should fall in line. It is the government's thinking. That's why online renewal. No question of earlier registration means without a personal hearing, registrations were not being given earlier. Now the regime has gone. This year amendment, everything e-filing, including appeals, including assessment, including registrations, renewals, only electronically. So please apply for that school, satisfy all these conditions. Definitely you can get the registration in Jharkhand. So this Parvati Srinivasan. So, sir, any other question?
Yes, sir. That's all. No more questions, sir. No more questions.
Okay. Thank you, viewers. How many viewers are there, admin? Today, how many participated?
58. 58.
28.
58. 58.
58.
No problem. Reasonable attendance. Actually, even in a physical scenario, around 16 normally minimum attendance will be there. So even in this virtual mode, we had that minimum. So thank you all the viewers and for all the questions that are posed to me. And I thank the branch once again for giving me this opportunity to share my views. And only request to all the viewers is a speaker, how much time you would have spent, how much effort you would have done, what expectation a speaker will have, except a good heart to bless. Let the speaker live healthily for some more days. At least he can do more help to the profession. That positive and say expected every speaker, not only me, every speaker when he shares, the only consideration what we expect, minimum consideration, only consideration, nothing else is I seek all the good wishes from all the viewers. That's how I end my speech. Thank you for giving me this opportunity.
Sir, very much thanks, sir. Thank you very much, sir. Your elaborate explanation about the trust taxation and the recent amendments, sir. Very much thanks for your participation. Full effort to our Coimbatore branch, sir. Thank you, sir. Thank you. I transfer our Honorable Secretary to propose the vote of thanks. Thank you, sir.
Thank you. I welcome. Welcome.
Thank you, Chairman. Thank you, Chairman. I am very happy to propose the vote of thanks of third webinar of Coimbatore branch of Institute of Chartered Accountants of India. My special salute and thanks to the today's speaker and past chairman of SIRC of ICAI, Dr. E. Phalguna Kumar, for his elaborate and detailed presentation, sir. Thank you very much, sir. Sir, though if it is a dry area in the income tax, you have covered in a such a way to reach easily reachable to all the participants of this webinar. Thank you so much, sir. I thank all the participants of this webinar. Thank you very much and all. I thank the branch admin, Mr. Mailvanan, who has organized this webinar in grand manner. Thank you very much, Mr. Mailvanan. I request every member of the institute to participate in the future forthcoming webinar of Coimbatore branch of SIRC. Thank you very much. Thank you, one and all. Over to Chairman.
Thank you, sir.